In this video, we'll cover everything you need to know to get started with investing in stock markets. 1. What is a stock market? The stock market is a platform where stocks are bought and sold. Stocks are essentially ownership in a company, and when you purchase a stock, you own a small portion of that company. 2. How does a stock market work? The stock market works by allowing buyers and sellers to trade stocks. When a company wants to raise money, they issue stocks, and these stocks are then bought or sold by investors on the stock market. The price of a stock is determined by supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell a stock than buy it, the price goes down. 3. Types of stocks. There are two main types of stocks: common stocks and preferred stocks. Common stocks give you a portion of ownership in a company and a share of its profits. Preferred stocks do not give you ownership in a company, but they do give you a guaranteed return on your investment. 4. How to start investing in the stock market. To start investing in the stock market, you need to open a brokerage account. A brokerage account is a type of account that allows you to buy and sell stocks. There are many online brokerage platforms available, so it's important to research and compare them to find the one that's right for you. 5. Risks and rewards. Investing in the stock market comes with risks, but it can also be very rewarding. The stock market can be volatile, and there's always the risk of losing money. However, over the long term, the stock market has historically produced higher returns for investors. 6. Diversification. One important aspect of investing in the stock market is diversification, or spreading your investments across multiple stocks. This helps reduce your risks, as it means that if one stock performs poorly, your overall portfolio will not be greatly impacted. You can diversify by investing in different industries, companies of different sizes, or stocks from different countries. 7. How to research stocks. Before you invest in a stock, it's important to research it thoroughly, looking at the company's financial statements, analyze its competitive landscape, and read news articles and analyst reports. You should also consider its management team, growth prospects, and dividend payout history. Keep in mind that past performance is not a guarantee of future results. 8. Active versus passive investing. There are two main approaches to investing in the stock market: active and passive. Active investing involves constantly buying and selling stocks based on market trends and new events. Passive investing, on the other hand, involves investing in a diversified portfolio of stocks and holding on to those stocks for a long period of time. Passive investing is often seen as simpler and less time-consuming approach. 9. Common mistakes to avoid. When it comes to investing in the stock market, there are several common mistakes to avoid. Some of these include timing the markets. Trying to buy low and sell high can be difficult and often results in missed opportunities. Being too emotional. Letting emotions like fear and greed drive investment decisions is never a good idea. Being too focused on short-term gains. The stock market is a long-term investment, and it's important to have patience and long-term perspective. Not diversifying. Putting all your eggs in one basket is never a good idea. Not staying informed. It's important to stay informed about the market and the companies you're investing in to make informed decisions. By avoiding these common mistakes, you can increase your chances of success in the stock market. 10. Understanding market indicators. There are several market indicators that can provide insight in the overall health of the stock market. Some of the most common indicators include Dow Jones Industrial Average, an average of 30 large publicly traded companies. S&P 500, an index of 500 large companies representing a broad range of industries. Nasdaq Composite, an index of 3,000 technology and internet-based companies. The GDP, a measure of a country's economic output. Consumer Price Index, a measure of the average price of goods and services purchased by consumers. By understanding these market indicators, you can get a better understanding of the overall health of the stock market and make more informed investment decisions. Keep in mind that these indicators should not be sole basis for your investment decisions, and it's always important to do your own research and consult a financial advisor. The stock market can be a great way to grow your wealth over time, but it's important to understand the basics before you get started. Do your research, understand the risks, and start small.